Hello guys, in this video I'm going to quickly review today's market, the price action from today, and today's date is May 7th. So before New York open, I'm on the hourly chart right now. You see Nasdaq on the left hand side and ES on the right hand side. Before New York open today, there was an S&T divergence between lows, bullish S&T divergence within a fair value gap, and the fair value gap CE was seemingly respected, kind of. Here, let me annotate ES as well. And because of that, obviously, you could expect a rally into a buy side objective, buy side target, whatever the case is, at around New York Open or in the morning session, right? So because we had an S&T divergence, the low that forms or creates the S&T divergence, that low should be safe low, at least until it delivers buy side, right? So let's go down to 1 minute. Here I'm gonna mark 9:30, right about there, and 4 o'clock, right about here. All right, now let's dive in. I'm gonna just focus on Nasdaq. So here at New York Open, as expected, it traded initially into a 1 minute fair value gap, which has also an order block here. So it traded down into there. I'm going to delete the vertical line. Traded into there, respecting with the bodies. It rallied initially, and then it pulled back, rallied again. That rally formed, or let me put it this way, rejected at the CE of the buy side, which means market engineered liquidity at this high. Now you could expect, once it's engineered, you could expect a discount array or sell side, or whatever the case is, depends on the market, whether it's a range bound market or not. You could expect either run on sell stops or deep discount or range equilibrium. So in this case, from S&T, the low that formed the S&T divergence, we had a leg. This is definitely not on the 1 minute, but we had this leg here. This is probably, like, I would say 5 minute or 15-minute dealing range in the perspective of 1 minute. Let me delete this. So after that failure, price displaced lower, tested the range EQ, rallied, took the sell side one more time, and in this rally, what we have here is one sell side is taken out, second sell side is taken out, and it forms a third sell side. It offers 3 sell sides, meaning there's 3 drives pattern here. Now you could expect 3 drives pattern to send the market higher because it is delivering sell side twice, so it's doing the job. Once it finishes the objective, it rallied. But here there's one more thing here. Let me annotate that as well. That's the first thing I just saw. Secondly, I think that this is what I mentioned in the stream. There's a price accumulation above the fair value gap a little bit, and there is an engineered liquidity. Once it displaces lower, now my eye goes all the way down into here, the sell side, because in the market maker model perspective, this is an original consolidation and the high probability, or the highest probability target, drawn liquidity. So it raided there. Well, one more thing here, with that raid, it is forming a new dealing range now because the sell side is taken out. Now you have a new dealing range from high to the low, which raided the sell side. That's our new dealing range. So you get a premium fair value gap here. Now, as you can see, the range equilibrium, I'll zoom in a little bit. As you can see, the range equilibrium is being respected with the bodies. Whenever you see this kind of price action, and whenever you have a drawn liquidity in the same direction, this is a very, very good high probability setup. This is one of my probably like A plus setups, because this gives you the best entry with little to minimal drawdown. Basically, it's a sniper entry. This is my favorite execution pattern or strategy. So, moving further, that was the highest probability short for me, and in that short, I did not take it during the live stream because the reward for me was not there. So, there is a new short-term sell side. You can target that from the range EQ, which yields, I think, 20 points, 20, 25 points, which is, you know, not good, not bad, it's mediocre. Anyways, let's move on. So we have the 3 drive, first sell side lower, second sell side lower, in the third one. With that third one, you can see there is a rejection here. Market rejects that level, and the following candle of the raid is an up close candle engulfing the down close one, which means market has just formed an order block here. What does this tell me is now we have the 1 minute order flow has changed, and now the market has to respect the order block and deliver some buy side. The way you read the order block is you look at the open price for bullish order blocks, and you look at the mean threshold. So the mean threshold is the furthest market should go, or the furthest market should violate or manipulate. So it rallied initially, which was a shallow run, then it dumped and came down into mean threshold of that same order block. Now in that price action here, the market is consolidating. Where is it consolidating? It is consolidating right below SCB, bearish fair value gap, right? It's accumulating. Then it formed an SMT divergence here with a yes. There's a bullish SMT divergence, and at 10:35, it inverted the fair value gap. Now, once that candle closes outside that SIBI, the whole accumulation here from high to low, or you can also take it from the smooth edges if you want to, doesn't really matter. It becomes trapped shorts, which means market is trapping shorts. This is a way or a form of smart money reversal in the market maker model. You guys already know that. So it rallied, trapped the shorts. Now in that trap you have a couple of things. You have a breaker block, you have this order block still, and you have a fair value gap. That fair value gap is a long entry in the new order flow, targeting the external liquidity, engineered liquidity here. That was the highest probability setup for my liking in the morning session, which yielded let's see, 37 points, almost 38 points, which is pretty decent. I would say anything above 30 points is a good trade. But then we had a choppy afternoon session. So in that chop, there's one more thing here I forgot to mention. In this accumulation, the wicks are actually rejecting the CE of the sell side. Okay, so in that trap, S&T divergence is being rejected at the sell side, which means now you have a new engineered liquidity. This time it's at the sell side. Okay, so if at any given time, engineered liquidity sell side, if at any given time market starts stalling, consolidating, kind of acts like a smart money reversal, is forming up or whatsoever, this low is your highest probability target. Why? Because if I go on the higher time frame, you'll see that chop is where markets shift the structure, essentially. So it'll want to rate that low. Whether it'll reject it or not is another story, but I'll talk about it later on. Let's look at the price action for now. In the context of market maker model, let me go back on the 5 actually. Forgot to mention that. This area becomes the horizontal consolidation from engineered liquidity to smooth edge. This consolidation price action, consolidating price action becomes the horizontal consolidation. If the market starts stalling and forms or forming smart money reversal at some point. If it doesn't do that, obviously the sell side is out of reach. Now let's go back on the one. In 1 minute, like during lunch hour and afternoon session, it was kind of choppy on the 1 minute, and it was giving a lot of different signals. I had a short here which got stopped for like 10 points or so, like $200 loss. And the thing I missed here in this execution was before I executed in this candle. I'll zoom in a little bit. This is a little detail I just missed, and it cost me $200. Look at these candles, 1134 and 1135. Look at the bodies. The bodies are smooth. What does this tell you? This is a PDRA. This is a rejection block. Okay, which makes the fair value gap I executed in less probability or low probability fair value gaps, essentially. If I had spotted this before I executed, I wouldn't have traded that fair value gap. I wouldn't have executed in that fair value gap. But the idea was I wanted to target the engineered liquidity sell side because prices started stalling here. I was thinking about price at least wants to go into a dealing range equilibrium, which is this red shaded dashed line. It did not do it because for whatever reason it rejected here and rallied. But that was the idea. I was not like super confident about the engineered liquidity sell side just yet, but I thought at least the EQ of the range should get tagged, which was not the case. So, moving further, consolidating price action. That price action there is not a lot, but one more thing, one important thing about this price action is, if you look at the highs, here, let me just annotate the CE of that quick. If you look at the highs, price is trying to, this is the sign of weakness. Price is trying to raid the buy side, but it keeps rejecting and rejecting and rejecting like several times. 1, 2, 3, and it's third time it's rejecting. It's failing to it's failing to break out. So it's failing to go like this. That's a sign of a weakness. Now you can expect a consolidation, and that consolidation ends up being a smart money reversal, so you can look for shorts or be flat and just taper the market. So that's the first sign for you to avoid this whole price action. Now let me go up to the 5 because that was essentially a 5-minute sell model which panned out. Price is accumulating, or it was accumulating here. This ended up being a smart money reversal. There is a run to buy side. Run to buy side. I wonder if there's an SMT divergence there with the YM. Yeah, there's an SMT divergence with YM. I know there's none with ES, but it was with YM this time. And immediately after the equal high raid, it just broke down, and it was gone at that point, and it didn't give any entry whatsoever. It was just drawn into the highest probability target, which was engineered liquidity, and that there was a trade in there which I missed, but it's okay. It yielded 75 points in the afternoon section. So let me go back down into the 1-minute chart, and you'll see the trade there. Also, let me annotate the dealing range here. All right. So we had the dealing range there. The first rally, or for the first dump here, it was rejected, but it never. So this manipulation should have came into range EQ. It did not. Because of that, it was likely to fail to have a breakout, and it never broke out. Now, second time when it came down, still it's nowhere near the range EQ. Came third time, still nowhere near the range EQ. And in this third rally, it also engineered liquidity here, which is not a significant level, but you can anticipate a range EQ manipulation or reversal. Here, let me move further. So you should not be trusting, um, you shouldn't be trusting these, hold on, not this tool, wrong tool. Here, these dumps, you should not be trusting these dumps because these dumps are not pullbacks or not reversals. It could be a reversal, but it's definitely not a pullback because it's not coming down into range EQ. Remember, it has to come or move from discount to premium or premium to discount to run on liquidity. Okay, so if you were to be long in this one, expect to get stopped out, honestly, because you're longing in premium in a range bound day. Same deal here, same deal here, same deal here. So it ran on the equal highs. After that, it broke down and almost immediately rejected that level, and this was the trade. The first fair value gap was the trade, touches there, so it sells off. So this was a 5-minute sell model, but the entry was given on the 1 minute because it was heavy, rather. So here, let me read it more. So it retested the fair value gap, IFED, sold off. There's nothing much in that price action. It formed an order block here. This candle, 150 candle, and that candle's mean threshold was also significant. It's rejecting there, and the open price is an order block. It also rejected there, and after all, it just delivered the engineered liquidity sell side, and that was it for the day. Now, what I would like to do is I would like to look deeper in this price action and try to see why Nasdaq decided to stall at this level. Now, I'll go on the higher time frame to see what's going on. Here also, oh no, never mind. Here in this price action also there was an SMT divergence here before rating the engineered liquidity in between ES and Nasdaq. So it formed a new, you could turtle soup that SMT divergence, by the way, because you know the drum liquidity, it could be a turtle soup, high probability turtle soup, and then it displays, there are fair value gaps here. You can also trade that fair value gap and put your stop loss above the SMT, because that high should be safe high if you're correct about your bias. And delivered tension good sell side. Now let's go on the higher time frame real quick and try to see why price rejected at these highs. Like what caused the rejection. So for that, I guess I need to go on the 1 hour. So here, this is the level. This is me reverse engineering this price action right now, because I also need to check these things so I'll have better understanding on the long run. I'm also going to annotate the, what is it called, like the bodies. Oh, also I forgot to mention, so let me go on the 15-minute. The last manipulation, you can also look at the standard deviation of that level, which is -2, excuse me. -2 was delivered. I think it reached to -2.5, I believe. Oh, no, actually, no. Failed to go there. Okay, -2. So let's see. -2 is also the bodies on the hourly chart. I want to see what's there. This is a major level, I think. Something's going on there. So let me zoom out a little bit. That's too much. So first things first, we have a fair value gap there. We have a fair value gap there. Let's see what it's doing. Oh, that's very algorithmic. It's just doing the damage and sells off afterwards. very algorithmic. Also, one more thing, ES already took out this high, so there's an SMT divergence. Now here's the unknown part. I don't know if Nasdaq wants to catch up with ES. I would rather have Nasdaq not catching up, but we'll see. We go on the 4-hourly. Let's see what's going on the 4-hourly. So that level on the 4-hour is the bearish OB, the scandal right there, and the mean threshold. Let's see, maybe the mean threshold was respected as well. I mean, it obviously did, but I want to see how bodies are. Oh yeah, the algorithmic delivery happened on the hourly fair value gap for sure. I can see it in the 1 minute even. Let me go on the daily real quick. I believe Nazmi mentioned the CEO of this fair value gap as well. That's a good confluence too. There's an OB, which was kind of violated actually. Yeah. So that was the New York session. Here we have a small range candle on the daily chart. So going tomorrow, I think the safest thing to do would be just like trading towards previous day low, which is today is low actually, into the fair value gap, and then leave runners. Maybe it'll expand further. I don't know that, but we'll see. On the 15-minute look, here's the 15-minute. Here's the daily low, previous day low, which should be the draw on liquidity also, because we have a 15-minute. I can make a sell model here. Here I'll show you. Price accumulates. Price accumulates above a fair value gap. Doesn't go anywhere, it's just range bound. This is the fair value gap. And the moment it inverts that fair value gap, now you have confirmed smart money reversal and confirmed trapped positions. Now once it closes like this here with the 145 candle, now you have a BPR, which is SCB, EBISI, overlapping SCB. Now this BPR should hold price until it gets down into the original consolidation low. Here's the original consolidation, smooth edges down to the south side. This consolidation here is your market maker sell model, drawn liquidity. So I would favor price staying below here, respecting the CE at least, and then going for the lows. I think that will be the highest probability trade for tomorrow, or overnight session, maybe London session. We'll see. We might get a rejection from there as well, but overall, the moment it forms a sell model of some sort, we have a long way to go. Because if it starts curling down, this is the sell side of the curve, buy side of the curve. Use the smart money reversal. So yeah, that's it, guys. I'll see you tomorrow in the live stream, at 9 o'clock. Until then, take care. Have a great night.